Okay, everybody, welcome. And today we're starting chapter 12, handout number 17. I kind of switched this around a little bit to put the preliminary questions and then the heading. I moved to the second page. So if you go out and grab this online, you'll have these two first pages reversed, but don't worry about that. You'd start by doing the practice questions. We'll cover them in like somewhere between 3 or 4 minutes. And then we'll jump into the material. Hello, Sonia. So we're doing handout 17 that is located in our class notes. And just know I swapped the first pages, so your page maybe looks like this one, but it's the same thing. It'll have the preliminary questions on page 2. I didn't hear that. La 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 la. I understand. That's the bummer of starting new material. People don't want to confuse their brains, and I don't blame them. All right. So let's talk about these. So first question, among the short-term obligations of Larson Company as of December 31st, the balance sheet date, are notes payable totaling $250,000 with Denison National Bank. These are 90-day notes renewable for another 90-day period. These notes should be classified on the balance sheet as current liabilities. Which of the following may be a current liability? Withheld income taxes, deposits received from customers, deferred revenue, or all of the above. Which of the following is not a condition allowing a company to exclude a short-term obligation from current liabilities? So liability is contractually due to be settled more than a year after the balance sheet date. So that would be a condition that would allow it to exclude it. The obligation must be due within 1 year. And so that would not allow the company to move it from short-term or current liabilities. Which of the following gives rise to a requirement to accrue a liability for the cost of compensated absences? So the payment is probable, right? Compensated absences, so you're going to pay what you're owed. Employees' rights vest or accumulate, and the amount can be reasonably estimated. And so the answer is D here. And then the answer is when, our question is when a contingent liability recorded. And so you have to be able to estimate it, but you also have to know that it's probable to occur. And so that is B. So So our answers here are A, D, B, D, and B. So we kind of take a step back after we got, bless you, into some complicated stuff, and we're just talking about liabilities. So what is a liability? It means that the company has incurred an obligation. And so what does that mean? What are the three requirements? First one is a present obligation to settle in cash, goods, or services. It is unavoidable. And we all know most of this stuff is avoidable by bankruptcy, so they don't mean it's not completely avoidable. It just means under the normal course of operations, you're obligated to pay it, and the law would say you're obligated to pay it. And number three, transaction has occurred. Okay, so just to kind of jog our memory, what's some current liabilities? This is where you guys say stuff. Accounts payable. Sometimes you'll see it listed as trade payable or separately. What else? Wages payable. Excellent one. Income and sales tax. Those are both separate, by the way. Income tax payable, sales tax payable. Those are two. And then accrued liabilities, which I just want to remind you about. And there's, interest payable, wages payable falls under here because we've got to accrue it. Warranties. Those are some examples there. Okay. Now we'll talk about accounts payable and how you make the entry for accounts payable. So accounts payable is usually trade accounts for amounts due to suppliers. There's generally no interest charged customers, and the payment dates range from cash on delivery to 180 days. But usually 15 to 60 days. Okay, and we would debit the asset something like supplies, materials, inventory. And then you would credit accounts payable. Purchases may include discounts, such as sales volume, cash discounts, and purchase adjustment discounts. When receiving a discount, debit accounts payable, credit cash. No, that's not right. Now that would only be if it came after. Give me 1 second. When receiving a discount, you're going to credit because we didn't pay for it yet. So we're reducing our accounts payable and usually crediting an asset account, supplies, materials, inventory, etc. Sometimes the purchase is reported net of the discount. So you'd have a debit to the asset at the discounted value. And then credit accounts payable at net value. And then there would be no entry for the discount. Hey, notes payable. What are notes payable? A written agreement with terms longer than accounts payable and should include interest. Paid to the holder. If no interest is included, then companies must impute the interest based on their borrowing rate or a rate similar to borrow for the asset. So if they don't have any debt outstanding, they can't say, well, if I would go out there, what interest rate would I pay on that asset? But you can look up, let's say, a truck loan and see what it is for business, and you can use that interest rate. So that's why you have your borrowing rate or a rate similar to what others would borrow for the asset. And we have to remember, if the note payable is above or below interest rate expected, it will be a premium or discount on the note. So your entry would be to debit cash or asset, and then credit let's put a debit here for discount, if applicable. Here, credit note payable for the liability, and if applicable, credit premium on note payable. And again, if applicable. So you'll only use one of those. You'll either use a discount or a premium. You won't have both. And then you have to accrue interest expense. So at the end of the period, you debit interest expense, and you would credit interest payable. And then note, if a premium then debit premium to amortize it. If a discount, credit the discount to amortize. And then the zero interest bearing note is a note that does not specify interest, but the loan, the note holder, and the borrower have to impute a rate to record the purchase and interest expense / revenue. I'll give you a minute to get that all down, and then I'll go over example 1. Okay. Greason Corp. signed a 3-month zero interest bearing note on November 1st, 2020 for the purchase of $500,000 of inventory. The face value in the note was $507,000. Greason used a discount of note payable account to initially record the note. Assuming the discount will be amortized equally over the 3-month period and there's no adjusting entry made for November, the adjusting entry made at December 31st will include. And so we start here and we calculate the discount. And so we have face value of 500,000 I'm sorry. So 507,800. And what they got for it was 500,000. So the discount is 7,800. Now they do straight line amortization over the 3 months. So 7,800 divided by 3 equals 2,600. And I think we have to amortize for 2 months. So 2 times 2,600 equals 5,200. And so your entry would be debit interest expense for 5,200. And you would credit discount on note payable for 5,200. And so that answer is B. Any questions? Okay, let's take a look at example 2. So the first thing, it says the effective interest on a 12-month zero interest bearing note payable of 400,000 discounted at the bank at 7%. So we want to know the effective interest rate. So we have to find the annual interest at the discount rate. So it's principal times rate times time. And here we have 400,000 multiplied by 0.07, the 7%, and then multiply that by 12 over 12 because that's 1 year. And that equals 28,000. And so you take the 400,000, subtract the 28,000, and you have 372,000. Oh, that was 280 there. Sorry, that's just supposed to be 28. And so this is our net proceeds. And so what we do is we take the 28,000 interest expense, or interest rate, sorry, and we divide by 372,000. And that equals 0.0753 or 7.53%. Any questions there? Keep in mind, usually when they give you an annual interest rate, if it's compounded more than one time a year, your actual interest rate is going to be higher. It's just the way it is because it gets compounded. You guys try practice 1. And I'll give you about 2 or 3 minutes for that. Anybody need another minute? Are we good to go? Okay. Take your time. Okay. So actually, this one doesn't have, there's a little typo here. This is supposed to be 700,000. Sorry, that one's 720, this one's 700. Okay, that's why I got that's right. All right. I thought they were doubled. Mine shows a different order. Okay. So it borrowed 700,000 on October 1. So the borrowing is 700,000. That would be the note payable. And then you have the difference, 720,000 minus 700,000. And that equals 20,000 of interest. And so interest is over 5 months. So 20,000 divided by 5 equals 4,000 per month. And we have 3 months, October, November, and December. And so that equals 12,000. So our answer here is 700,000 and 20,000. Now a little note here. If the instruction said 0 interest note, then the note payable would be recorded at 720,000. The answer is 12. Oh, I'm sorry. It's supposed to be 12,000. Yeah, I was right. Okay, so there is, I'm sorry. This is supposed to be 700,000. I was right. I knew there was an error on the sheet. I just missed it. So 712,000. Now, if the note was 0 interest bearing, then it would be the 720. Any questions? Okay, we're just going to talk about some of the other liabilities that you'll come into and see. So what are dividends payable? An obligation to pay dividends. When the board declares the dividend. Debit retained earnings. Credit dividend payable. Customer advances and deposits. So advances and deposits, when they come in, they're kind of trying to separate this from unearned revenue. And the way that they do that is essentially they say these are payments that will be refunded to the customer as long as certain conditions are met. So advances and deposits would be something like you put a deposit on a rental place for security. So if you didn't pay the rent, they would take that security deposit. But in general, you would get that back. That's different than unearned revenue when this is payments in advance for goods or services to be delivered or performed in the future. All right, let's say in a future period. Now, the future sounds right because it doesn't necessarily mean it's outside of a year. Bless you, or cough, happy cough. All right, and so you've got practice number 2 here. I'll give you guys about 2 minutes. Sure can. Okay, so total revenue equals 6,000 times $150, and that's 900,000. And so there are 7 months in the first year. So 5 months remain at December 31st. And so we have 5 divided by 12 times 900,000. And that's 375,000 of the balance remains. Any questions? Okay. Sales tax payable is a tax on the sales price. Goods usually paid to the state or local city/county. Customer pays the tax and the company records a liability until they pay the tax. Actually, it's called they remit. They remit the tax to the authority. And so you would have a debit, cash or asset. You would credit sales or revenue, and then you would credit sales tax payable. Hey, example 3, bargain surplus made cash sales during the month of October for $375,000. The sales are subject to a 6% sales tax that was also collected. Which of the following would be included in the summary journal entry to reflect the sales transaction? So summary entry. A debit cash, and that cash is going to be $375,000 plus sales tax. And so I'm going to multiply by 1.06 because that's the 6% sales tax. And so I get $397,500. And then we credit sales. And that's $375,000. And credit sales tax payable of $22,500. And this should be 375 times 0.06. Any questions there? Okay, let's take a look at example 4. Okay, Valley Inc. is a retail store operating in a state with a 5% retail sales tax. The state law provides that retail sales tax collected during the month must be remitted to the state during the following month. If the amount collected is remitted to the state on or before the 20th of the following month, the retailer may keep 3% of the sales tax collected. On April 10, 2020, Valley remitted $203,700 tax to the state division for March of 2020 retail sales. What was March 2020 retail sales subject to sales tax? So here we have 203,700 is our sales tax. And that equals our sales multiplied. What's that? Sure. So that equals our sales times 1 minus 0.03 because they only had to remit 97% of it. So we have 203,700 equals sales times 0.97. So you divide both sides by 0.97. and we get 210,000. Okay, and that's the tax collected. And so now we take the 210,000 and we divide by 0.05 to get our sales. And that equals 4,200,000. Any questions? So that's it, right? Anybody else have any other questions? Okay. Oh, sorry. So we're not going to start this one today. Oh, I forgot. I didn't. No, she doesn't usually want one, so we're good. So we'll pick up with handout 18 on Tuesday, and that is it for today. No. Yeah, we were ahead, so I had the choice of, cutting it here or trying to push into this one, but it doesn't make sense. So you guys are free to go. You too. Don't forget your test this weekend, please. What's that? Don't forget your test this weekend. Bye, Sonia. Have a good day. Don't forget your exam this weekend.